Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 332 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including investing versus gambling, stock splits, how getting out of the market at the April bottom would have hurt your portfolio, and finally, volatility has dropped and sentiment has risen. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. So let's jump in. It's good to be back, Matt.
It's great to have you back.
I feel like it's been 2 months, been a lot going on in life.
There has been a lot going on in life. Why don't you enlighten our listeners and viewers what's been going on at the McEvely household?
Yeah. So on Thanksgiving morning, we welcomed our second daughter into the world, Poppy K. McEvely. Mm-hmm. So she was 3 days, 3 days late. So my wife, Kenzie, was due the Monday before Thanksgiving, and then Poppy came at 4:56 on Thanksgiving morning.
Fully baked?
Fully baked. So, yeah, it was good. You know, obviously, Kenzie was ready for that baby to come out. And it actually ended up working out perfectly because my mother-in-law was in town. My parents got to the house on Wednesday night. So everyone was there to take care of Mia while we went to the hospital in the middle of the night. But it was quick. Yeah, things progressed quickly. And, like I said, she had the baby just before 5 a.m. and we were home at 6 o'clock on Thanksgiving night, which was great.
It's just phenomenal. She's doing great. It sounds like new baby's doing great. Mia's doing great.
Yeah, that was the one thing I was worried about. I thought Mia would be pretty jealous, but she hasn't been at all. Like, she just wants to love on her and hug her and kiss her and snuggle her and hold her. So it's been a lot of fun.
Very fun. I'm glad you shared that with everyone.
Yeah, so it's good. Yeah, holiday season. I can't believe we're at the end of 2025 and this is the last episode of the year, but I think we have some interesting things to talk about here over the next half hour or so.
Yeah, I'm excited to be back on the saddle with you.
Yeah, me too.
Me too. You want to start with pricing?
Sure. So these numbers are as of the market close on December 22nd. This information here is from YCharts. S&P 500 index is up 0.4% for the month and up 16.9% for the year. The Dow Jones Industrial Average up 1.4% for the month and up 13.7% for the year. The NASDAQ Composite Index up 0.3% for the month and up 21.3% for the year. The Russell 2000 Small Cap Index up 1.9% for the month and up 14.8% for the year. And the Vanguard All World ex-United States Index Fund up 0.3% for the month and up 27.5% for the year. 3-month Treasury rate at 3.64%, the 2-year Treasury rate at 3.44%, and the 10-year Treasury rate at 4.17%.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
So obviously with us doing this podcast every week, Matt, we notice the changes in these numbers, right? And the thing that's sticking out to me right now is, are the yields on the U.S. Treasuries, right?
Yes.
So it was just a short time ago where, yields on short-term bonds were substantially over 4%. And here we are, it's sitting at, just over 3.5% for the 3-month and just under 3.5% for the 2-year Treasury. And obviously a a byproduct of the Fed lowering rates.
Yeah, I mean, we talked about it recently on the podcast. You have a situation where the Fed was doing quantitative tightening. They were taking printed money out of the system, and that has not only ceased, but they're going to begin a version of quantitative easing of printing money again and injecting that into the system, as well as most likely a continued downward path or pressure on interest rates, as you had mentioned. What's, I think, a good observation, if our listeners and viewers haven't noticed yet, is the stickiness of longer dated yields. So if you look at where the 10-year yield was, say, even a year ago, it's kind of right where it was. It hasn't really moved down. And I think that if you are watching the bond market right now, watching the movements on especially the 10-year yield is very intriguing right now.
Yeah, I would agree. And obviously there's some doubts that the Fed is going to continue to lower rates into 2026. I think the last time I checked the futures market, and this could have changed by now, is that they're penciling about 2 cuts in. The futures are so, but there are concerns that they're done cutting for now, right? Because they're still trying to balance this, price inflation versus increasing unemployment. Now that's becoming more of the focus, and people are like, well, the market's at all-time highs, so why are they even cutting rates, right? Is because they have that dual mandate that they're trying to balance, and for the last couple of years, it's been on inflation and prices, and now it's kind of switching to employment, right?
Yeah, I'll be curious. I think the last set of CPI data came out on December 18th, and it showed year over year at 2.7%. So I'll be curious to see how that evolves over the next couple of months and how that affects the expectation of further cuts. The only stat I can throw out there real quick is, as of 2 days ago, I saw the CME futures probability of a cut at the end of January meeting was only at 22%. So obviously, if they're going to do it, it's going to be later into 2026, most likely. Mm-hmm. One other observation I want to throw out there is the relative strength of international stocks, non-U.S. I saw a piece. It didn't make the cut for the podcast this time. I'm going to have it on the next one that I'm on. Market overlays the U.S. dollar index of Trump's first term.
I saw this.
Have you seen this?
Yeah.
Versus his second term. The correlation is amazingly very similar, right?
Yeah.
And I just want to throw it out there that, these international stocks have been benefiting from this environment of a weaker dollar. And if history repeats itself of Trump 1 versus Trump 2, the peak of weakness in the dollar was somewhere, it looked like on the chart, end of Q1 of next year, beginning of Q2. I'll be curious if this starts to gain some steam, this thought that, well, I'm going to own international till then, and then I'm going to sell it because the dollar will begin to strengthen again. I'll be very curious if people do this playbook.
Yeah, that's actually, I also saw something else. I thought it was from, excuse me, I'm fighting a cold here, so apologies for the sniffles and coughs throughout the way.
You're getting a lot less sleep the last couple of weeks. That always affects your...
I think it was from, Subu Trade, who we've mentioned a couple of times.
I got a piece from them today.
I think, did it have to do with the U.S. dollar?
I might have reposted it. To be honest,
you might have. Maybe it was you. But anyways, to your point of the dollar acting the same way in Trump's first presidency to now, we had what they call a golden cross in the U.S. dollar, where the 50-day simple moving average crosses above the 200-day simple moving average, and this account on X, who does a lot of research, posted, "Hey, here's what's happened to the U.S. dollar's future performance after this golden cross."
Interesting.
And guess what? Out of, it was, 12 out of 12 times or whatever, 1 year later, the dollar is significantly higher. So it's just kind of funny how those things are lining up, that at some point, probably in Q1 next year, we might see some more strength in the U.S. dollar.
Very interesting, Mr. McEvely.
Yeah. Love how that comes together from time to time.
Oh
for
my
us.
gosh. Don't you just love doing the podcast together?
I do. I missed it.
I'm a
I
kid in a
did.
candy
Yeah,
store.
it was like a part of me was gone for the past couple of months. But
Kid in a candy store. You want to switch to big headlines and current
I think
events?
we're still seeing a lot of these economic reports roll in delayed from the government shutdown earlier this fall. And one that just came out this morning, actually, I don't know if you had a chance to see it, was the U.S. Q3 GDP report. Was released this morning. So this was a couple of tidbits from the Wall Street Journal. They said the U.S. economy grew at an unexpectedly robust pace in the third quarter, according to a shutdown-delayed government report. The Commerce Department said gross domestic product, the value of all goods and services produced across the economy, rose at a seasonally and inflation-adjusted 4.3% annual rate for the July through September quarter. Growth picked up from 3.8% in the previous quarter and beat the 3.2% forecast among economists polled by the Wall Street Journal.
That's not just a beat.
Substantial.
That's substantial. I was watching an interview of Secretary Bessent recently, just actually last night. I was putting together some items for Christmas. You and I talked about before we started recording. And he was mentioning one of the targets they have is minimum of 3% GDP growth, right? Was one of their items. And to sit there and see it come in at 4.3, that's a big number.
Again, I think that, if we had to characterize 2025, and I think this could be said for a lot of other years, right, is it's kind of a year of surprises, right? Where people think one thing's going to happen and then the opposite happens, right?
Yeah, but I would argue the bingo card surprises this year were tremendously above average.
Right.
You and I are kind of conditioned to kind of joke with each other. Hey, that wasn't on my bingo card.
Yeah, right.
I'm out of bingo cards, buddy. I had to put the reorder in already.
Yeah, okay. That's true. That's true. So, all right. Well, moving on to tweets, articles, research for the week. The first thing I had, Matt, is I've been sitting on this one for a little while. This was a newsletter from our friend J.C. Peretz earlier this year on November 25th, titled "Sports Gambling is Not Investing." So I just want to read a couple of pieces here and we can talk about it. He says, there's been a lot of chatter lately about traditional brokerage firms opening the door to sports betting markets for their clients. You can kind of see where this is going, right?
Okay.
Let me be crystal clear, and this is JC talking. That does not mean betting on sports is the same thing as investing. These firms are publicly traded businesses. Their job is to increase shareholder value, even if that means encouraging behavior that has nothing to do with long-term wealth creation. But don't confuse the two. Sports gambling is short-term, speculative, and structurally designed to separate you from your money. The more you play, the worse your odds get. Investing is the opposite. It involves strategy, discipline, and the power of compounding. The longer you play, the better your chances of success. Time and discipline drive real investing outcomes. Gambling relies on chance. Gambling feeds on emotion, impulse, and the cheap thrill of a quick outcome. Investing is the opposite. It's about following a plan, staying disciplined, and identifying favorable risk versus reward opportunities. It's not about dopamine hits. In fact, good trading is boring.
That's well done.
It was an interesting one for me because I know I at least have gotten the comment several times from meeting with people where they say something along the lines of investing is no different than gambling, right? And respectfully, I disagree. And I think JC does a pretty good job explaining how blatantly different the two are.
I would speculate in saying the reason some people might think that is the evolution of day trading over the past couple of decades.
Right.
And they must think in the realm, Mark, of very short-term time horizons, literally hours, days, and weeks, not weeks, months, and years. And I think that is a big component of it. And I just want to throw that out there. I just think that has a lot to do with it, if it makes sense.
I think it does. And we talked several times before about how, these couple of generations are such a, instant gratification generation. And just like how, stock trading you're able to do from your phone. You're able to bet on sports right from your phone too. So it's kind of following the technology progression has kind of been the same, but they're two very, very different things.
Yeah, I mean, here's kind of my cheat when it comes anytime the topic of sports betting or sports gambling comes up. That, in my mind, should be completely compartmentalized to entertainment. You have a budget for that entertainment, right? And you treat it as such.
Yeah. Yep. Good point. Second thing I had was an article from Rocky White with Schaefer's Investment Research on November 18th titled "Buying Netflix 10-for-1 Stock Split? Expect Underperformance." So this article discusses stock splits and how publicly traded securities' future performance are affected by the split. And I think first it's important to explain what a stock split is for people who haven't listened to us in the past.
Love it.
So very simplistically, a stock split is when a publicly traded company increases the number of shares outstanding by dividing each existing share into multiple shares, right? And this is without changing the company's total value. So nothing fundamental changes about the business. In plain terms, you just own more shares and each share is worth less, right?
Yep.
So for example, if you own 100 shares of McEvely and Jessup stock at $200 each, which would be $20,000 total, and the company does a 2-for-1 split, you'll own 200 shares instead of 100, each at $100 a share, still worth $20,000, right?
Correct, yep.
So one may be thinking, what's the point of doing stock splits? So a lower share price is, in my opinion, psychologically easier for investors to buy, especially retail investors. So, Berkshire A-class stock is what, 100,000 or something along those lines.
It's mid
per
six
share.
figures, yeah.
So, a lot of people can't buy one share of Berk A, right?
Yes.
So in this case, Netflix was, pushing the $450 a share, $500 a share. So they recently split 10-for-1 and it's become a lot cheaper, right? Or maybe they were pushing 1,000 a share. I can't even remember. But essentially, more shares outstanding at a lower price usually leads to tighter bid-ask spreads and more active trading. So it increases liquidity.
Yes,
right?
absolutely.
And that's important for the function of markets. And companies typically split their stock after a big run up in price, right? So management is, implicitly saying we expect this growth to continue. And, you've seen a lot of major companies do this over time. This isn't Netflix's first stock split. Amazon's done it. Apple's done it.
Sure.
Meta or Facebook has done it.
Yeah.
So this piece talks about how stocks perform after the stock split to see if there's a consistent pattern or a consistent theme. Right?
Yeah, I'm curious.
And this is where Rocky comes in with some of his data. So he says, using a lot of current optionable stocks going back to 2010, I have data on about 310 stock splits.
Okay.
Stocks slightly underperformed in the very short term after a split. The 2-week return for a stock after its split averaged 0.48%, which was less than the average return of the S&P 500, which was 0.6%. The average for longer term returns is barely above the corresponding S&P 500 returns, but only half the stocks out of the 310 beat the index. And that slightly higher average return comes with a lot more volatility.
Okay.
Netflix got significantly more affordable with a 10-for-1 stock split they just completed. Rocky wondered whether a dramatic price drop might make shares a lot more enticing for investors and lead to a better post-split return. To test this, he looked at returns for stocks that were priced above $400 per share before the split.
Interesting.
There were 32 stocks in the list in which the stock was priced above $400 before it split. After the split, these stocks declined 1.2% on average over the first 2 weeks, with just 38% of them beating the S&P 500. Going back to my first point, the underperformance lasts for about a month. But then the longer-term returns, 6 months and 1 year, beat the broader market average. Buying these high-priced stocks just after a split would have yielded an average return of 17.4% over the next year compared to 9.8% for the S&P 500. So again, the longer and longer you're involved, the more beneficial it is. So not necessarily a rhyme or reason to why. I just thought that that was really interesting because at least me, for my role at the firm, I get the question a lot. It's like, they see a big, Mag 7 stock name do a stock split and they're like, ooh, should we be buying this? And it's like, well, it's not a foregone conclusion that just because they do a stock split, the price is going to run over the next year.
No, well said. I got two follow-ups. One's my compliance hat. When we always talk about individual securities in the podcast, I want to make it very clear that we don't have a formal recommendation for our listeners and viewers for or against the name. So in this example, being Netflix. My second is a personal feeling. What I'm about to say, I can't back up with data. However, I feel strongly about what I'm about to say.
Okay.
And I want to be careful not to get too far into the weeds with our listeners and viewers, so I'll stay surface level. But I feel that once these stocks split, I bet you the options activity rises dramatically, the calls and the puts, because it's all based off of 100 shares at that strike price. And when that price comes down, people can tend to utilize more leverage. They can buy more of a stock option contract than they would have if the price didn't split 10 for 1.
Right.
And my theory behind this is you start kind of ratcheting up the leverage within that equity kind of behind the scenes, you're increasing liquidity. I think if I did a study, you're probably also increasing the volatility profile, if I had to guess.
Yeah, for sure.
That makes sense?
Yeah, because if you look at, and again, this isn't a recommendation for and against, but one of the most optionable securities out there is Tesla. And historically, Tesla, they've gone through stock splits. It's been a high-priced stock for a long time. And due to that, with the volatility, the options are usually pretty dang expensive, right?
Correct.
So when they do split those shares, they do become more affordable. It's just an example that came to me from the top of my head from the options.
Well said. Don't want to get too far in the weeds. Just want to throw that out there.
Yeah. Last thing I had was a chart from Taylor Schulte at Defined Financial. This chart shows the return of different equity indices year to date in two scenarios. So scenario one is holding the stock indices all year.
Okay.
Scenario two is selling stocks at the April low during the tariff sell-off if you got spooked by what was going on. Okay, so Jen will throw this up on the YouTube video, and this will be in the show notes. So this chart shows 5 different indices. So it shows emerging market stocks, developed market stocks, U.S. large companies, U.S. mid-sized companies, and U.S. small-sized companies. And what you're going to notice is all of these different indices managed a substantial recovery if investors held through the weakness in April. And in the chart, those returns are noted by the blue histogram bars on the graph.
Yep.
However, if investors sold back in April when the market was falling, they would more than likely still be down significantly in their portfolio for the year. And this scenario is highlighted by the purple histogram bars in the chart on your screen. So all in all, this is, in my opinion, a great example why we stick to the investment plan, right? And not try to jump in and out of the market just based on news headlines and things that are going on geopolitically. It's extremely difficult to do even for the best investors in the world, and
we have our challenges.
Yeah, and I know I've said this multiple times, but in April it seemed like the world was falling, right? And here we are, several months later, nearing the end of the year, and S&P 500's up double digits. So just another example of why,
going from being down double digits to being up double digits.
Right. So another example of why you got to put a game plan together and stick to it.
Well said. Well said.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
I'm going to start off. I'm going to talk about market sentiment is finally improving. So before I kind of go into the data on the chart, this is from Subu Trade, and it was referencing, Mark, the AAII sentiment survey. So I'm going to explain what that means to our listeners and viewers. The AAII sentiment survey, conducted weekly by the American Association of Individual Investors, it gauges the mood of retail investors by asking whether they feel bullish, bearish, or neutral about the stock market over the next 6 months. You can only answer one of three ways.
Right.
Right now, the bullish percentage has topped 44% for 2 consecutive weeks. Timestamp on this post is December 11th. The first time that's happened in over a year, which is why it caught my eye, signaling a notable uptick in investor optimism after a period of caution. This melds quite well with your last piece that you just discussed.
Right.
Historically, such sustained bullish sentiment has often preceded positive moves in the S&P 500, as it reflects growing confidence that can fuel buying momentum and support broader market rallies. So when you look at this data piece, when you look at it, when you have a 2-week stretch of the AAII bullish indicators coming in at 44%, and that being the first occurrence in over a year, there's about, what would you say, about 8 to 10 data points on this, 91, 94, 2000, etc. 6 months later, on average, the market's up 9.73%. 1 year later, 17.44. The only thing that scares me about the data set is on the 6 and the 1 year, the market in these previous instances wasn't down. Anytime I see 100% hit rate, at some point it's going to be down. Right?
Yeah.
But I just want to throw it out there that we've had, and I've been very vocal about this on the podcast the past year. Market sentiment's been poor. Finally people starting to change their tune a little bit. And guess what? It's not bearish.
Yep.
All right. My next piece is a reminder about S&P 500 concentrations. Okay. I saw a post, Mark, on December 13th from Compounding Quality, and this is exactly what the post said. The S&P 500 is more concentrated than ever. The top 10 names within the index now make up 41.1% of the S&P 500's market cap, the highest level on record. They generate 32.6% of total earnings of the index. Jenna will put up this chart that Compounding Quality put together that mirrors 2 data points going back several decades. One is the percentage of the S&P made up by the top 10 largest market cap companies through time, as well as their earnings of the index. Okay? So I dug a little bit deeper on this topic. Okay? A little bit of a detective. The top 30 names by market cap equal about 48 to 50% of the index. I wanted to give a breather for the market to move by the time I did this. The top 50 of 500, is it still technically 503?
I think it's 503.
Okay. So the top 50 of 503 equals 60 to 62% of the index. The S&P 500 index is more concentrated than probably most investors think. And for our traditional podcast listeners, I'm looking at Mark right now doing the think air quotes. For the NASDAQ 100, the top 10 stocks by market cap make up 52 to 54% of the NASDAQ 100, just 10 of them. Okay? For the Dow, made up of 30 stocks. The Dow Jones Industrial Average, the top 5, make up 31 to 34% of those names. Just want to throw it out there. People think, oh, hey, I got this S&P 500 index fund, Matt. I'm diversified.
Right.
You really aren't, buddy.
No, you're not. Yeah, it's a great point.
Let's call it for what it is. It's quickly turning into a mega cap index.
Yeah, it is. Yeah, and people have been pounding the table for years that it's a bad thing, and it hasn't been a bad thing yet, at least over the long term. At some point,
I just want people to acknowledge. I think
a
lot of people are reluctant to acknowledge this.
Yeah. If you hold the S&P 500, even though it has 503 or 505 names, whatever it is right now, that doesn't mean you're diversified.
Well said.
Yeah.
That's my point.
Yeah.
But there'll be people who disagree with me about that.
There will.
Okay. That's what makes a market, baby.
That's right.
All right. My third item is market volatility has dropped significantly recently. This was a post, Mr. McEvely, on December 12th by The Market Stats. And the post said the VIX, or the volatility index that we reference quite often on the podcast, has fallen more than 43% in the past 14 days. Again, the timestamp, December 12th. Historically, the S&P was up 12 out of the 13 times when this happened historically, 6 months later. Jenna will put up this illustration for our YouTube viewers. This will be in our show notes. Here's some notes I wanted to prepare to share with our listeners and viewers. The VIX, often called the stock market's fear gauge, is a real-time index that shows how much volatility investors expect in the S&P 500 over the next 30 days. It's calculated from the prices of options on the S&P 500 when investors are nervous and worried about big market swings, usually downward. They pay more for protective options, which pushes the VIX higher. When markets feel calm and confident, option prices drop and the VIX falls. In simple terms, a high VIX above the level of 30, or especially above 40, signals widespread fear, while a VIX below 20 reflects complacency or optimism. The chart that I just shared highlights times when the VIX has dropped sharply, more than 43% in just 14 days, typically after a fear spike has quickly eased, and shows the S&P has historically delivered stronger returns following those signals. What was also interesting is some of the time periods that the data set covered. It was about a baker's dozen, maybe a little bit more than that. And you're going to see, obviously, some time periods of April of 2020. What was happening then, Mark? Right? November of 2020, we got a 2022, March of 2022, hyperinflation was hitting. So some interesting data points. But again, you've seen that come in recently. Last I saw yesterday, the VIX was actually below 15, which is very uncommon. And it's telling. Thoughts, comments?
Yeah, volatility is like a pendulum. If it goes, too far in one direction, then eventually it's going to swing and
snap back
and come on back, right?
Yeah.
It's nothing is not impossible, but if you just look at this chart that you're talking about, the VIX tends to stay elevated for very short periods of time, right? Mm-hmm. If you really look at it on a long-term basis. Now, those swings can be very not fun and big to the downside, but more often than not, the VIX lives between that 12 and 20 range usually.
It does.
And again, I think of it kind of like in tranches, right? So if you're looking at the VIX, which, we've talked about what the VIX is and how it works in detail before on this podcast.
Yes, sir.
10 to 20 is, you're buying stocks. There's not really a whole lot of fear, right? Mm-hmm. 20 to 28 is like, this is a little shaky. I'm not as confident. And then above 28 is kind of like, okay,
fear is widespread.
This might not just be a pullback. So it's kind of like wait and see mode.
Well said.
So it's kind of like green, yellow, red, right?
That's a good way, simplistically, of throwing it out there. I like that.
Yeah, but it does. I mean, again, it's very simple to look up this data.
We're going to coin this the McEvely VIX gauge.
Yeah.
We'll have a little indicator. I could just see it all kind of coming through in my head.
Yeah, perfect. But yeah, I mean, just like, it makes sense though, right? I mean, the VIX lives usually, like I said, between 12 and 20 because 3 out of every 4 years the market is up. So that should happen.
I mean, you say it a certain way, perception's reality. And what's the most important thing is the price action. It is telling you something. And, when you see these spikes of volatility, everyone is so concerned on Wall Street to get ahead of the next big downturn. I bet you in the last 5 years, Wall Street has called 30 of the 3 good downturns.
Yeah, for sure.
Right?
Yeah, they have. Yeah, it's a fact. Okay, well, just closing out with the financial planning topic of the week. IRS released the tax brackets and standard deductions for 2026. So a boring one, but important, for people to know. So first, I want to read off the single 2026 tax brackets, and I'll move to married filing joint for 2026. Jenna will put this on the YouTube page. It'll be in our show notes,
Great.
And you can just look it up online if you need to.
Great.
So if you are single filing a tax return for 2026, $0 to $12,400 is 10% tax bracket. $12,400 to $50,400 is the 12% tax bracket. $50,400 to $105,700 is the 22% bracket. $105,700 to $201,775 is the 24% bracket.
I wonder who lobbied for that extra $775,
I was just about
baby.
to say, I was like, this is kind of ridiculous. $201,775 to $256,225 is 32% tax bracket, and then $256,225 to $640,600 is 35%, and then above $640,600 is the 37%.
So the highest bracket we got is 37%.
Yeah.
Got it.
Married filing joint, it's very similar, except you kind of double it a little bit. So I'll just read the lowest and the highest. So $0 to $24,800 is the 10% bracket, and anything above $768,700 is the 37% tax bracket. So standard deduction amounts have changed again for next year. So if you are single or married filing separately, the standard deduction is $16,100. Married filing a joint tax return, the standard deduction is $32,200. And if you are filing as a head of household, the standard deduction is $24,150. So there's actually an additional standard deduction for people who have reached age 65 or who are blind. And that additional standard deduction is $1,650 for each married taxpayer, or $2,050 for unmarried taxpayers. So
I think that special deduction lasts 4 years. I believe it was part of the OBBB that passed this past summer.
Yep. So again, these are adjusted for inflation usually every year. So again, they have gone up again. So the important part here is you really need to have charitable deductions, for example, that are greater than these amounts to have it make sense for you to itemize, right? So I would be guessing here, and I'd love to hear your 2 cents. I would guess that 88% of Americans use the standard deduction.
I was going to guess between 12 to 15%.
Yeah.
We're in a similar kind of thought process there.
Right.
I do feel next year is going to be an interesting year from a tax perspective because you have things kicking in such as no tax on overtime next year. Right. So that's going to be a biggie. I feel the special extra deduction that people of Social Security age and above, that will be something that'll be welcomed, I think, for a lot of people. I think it's going to be really interesting. I think the refund checks for those that usually get them could be a little beefier than normal next March and April. And we'll see if we get the typical, seasonal strength in consumer spending around that time. I mean, if you think about it, who has sales is all the furniture stores, right. Around that time.
Yep.
So it's just going to be interesting to see what this tax season looks like.
Yeah, well put. Well, thanks everyone for listening to episode 332 of the Independent Advisors podcast. Just a quick note, no podcast next week. We wish everybody a Merry Christmas and a Happy New Year. Thanks for sticking with us for another year, and we'll see y'all in 2026.
Take care, everyone.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.